Are you tired of low returns on investments? Do you have a lot of cash just sitting in your cash account, checking account, and earning even lower rates of interest with interest rates falling? Well, you're in the right place. Today, we're diving into the exciting world of covered call ETFs. Specifically, we're going to take a look at Hamilton ETF's unique lineup. This is not a sponsored video. This is just for me to keep you informed in the know on what covered call ETFs are they right for you, and the hidden risks about these ETFs before you invest your hard-earned dollars. Covered call ETFs can be a game changer for your portfolio, offering much higher yields compared to traditional investments out there, and a smart way to manage risk. So what makes Hamilton ETF's lineup for covered call ETFs stand out from this crowded marketplace? Well, I'm going to break down everything you need to know so you can make a smart, informed decision with your hard-earned dollars, because no one is going to care more about your money than you will. Just before we dive in, I just want to make it super clear, this is not a hype video for covered call ETFs. I'm not telling you to go out and invest covered call ETFs because they're the next best things since sliced bread. I'm going to break down what you need to know, the facts around covered calls, and should you invest knowing what the risks are. While yes, these ETFs can boost your income, but they come with their own set of risks, such as limited upside potential if the stock market rallies, not to mention the exorbitant fees some of these ETF providers charge for you to get access to these higher yields. So it's really important you peel back this onion of high yield, because that's some marketing play out there. They're going to show you 10% yield, 12% yield, 20% yield, but you have to understand what you're really getting for your investment dollars. First things first, what exactly is a covered call ETF? Imagine you own a basket of your favorite stocks. Now, what if I told you you could make some extra money on that same basket of stocks without having to sell them? And I'm not talking about just collecting those dividend payments. That's exactly where covered call ETFs come into play. Covered call ETFs, just like regular ETFs, hold a basket of stocks. That's where they're the same. But what covered call ETFs do is they take that basket of stocks and they sell call options on them. This generates a premium, which then gets passed on to you on top of the dividend, increasing the dividend yield. Covered call ETFs are great if you're looking for income, not necessarily capital gains. Because remember, if a stock price goes up considerably, your upside potential is capped. And Hamilton ETFs offers a wide variety of these covered call ETFs. So that's what I'm going to break down for you in this video, some of the more popular options out there from Hamilton, and here's what you need to know. The first one we're going to look at is HYLD, which is the Hamilton Enhanced Yield ETF, and it's designed to provide high monthly income through a combination of covered call strategies and leverage. That's an important distinction right there. Not only is it a covered call ETF, but it also employs leverage. And here's what you need to know about HYLD. One, people will typically go into this ETF because they're looking for steady income, and that's one of the main attractions of HYLD. It's its ability to generate regular income. It does this by selling call options on the stocks it holds, which, as I said before, it brings in premiums that are distributed to investors as income. This can be particularly appealing if you're looking for consistent cash flow. The next thing you want to know about HYLD is the blue chip exposure. HYLD includes top-tier US stocks, often referred to as blue chip stocks. These are your well-established, financially sound companies that can add stability to your portfolio. Next thing you want to keep in mind when it comes to HYLD and why people prefer HYLD or they invest in HYLD is because of tax efficiency, especially for Canadians. And that's because for Canadian investors, HYLD can be especially appealing when held in a tax-advantaged account like a TFSA, like an RRSP. And this can help you maximize your return by minimizing your taxes. Now, as I briefly mentioned, HYLD does use a modest leverage, borrowing up to 25% of its total value to invest in more of its underlying assets. This can amplify returns, but it also increases the risk. So it's important to understand this aspect before you start investing. Are you okay with that additional risk that comes with leveraged investing? And this HYLD is a covered call strategy, and that's why you're watching this video, because you may be interested in covered call ETFs. And as I mentioned, this involves selling call options on stocks that HYLD already holds. This means you're earning that extra bit of income from those premiums where your potential for capital gains is capped, especially as stock prices rise significantly. There is a trade-off right here with covered call ETFs between steady income and limited upside potential. And when I say limited upside potential, that means, let's say, bought HYLD for $15 a share. It might stay at 15, rise slowly to 16, 17. It's not going to rise significantly in price because what you're getting, instead of that price increase, is cash flow upfront in dividends and call premiums. Now, that may sound great and all, that you're going to get all this high yield, steady cash flow, monthly distributions. But keep in mind, this comes at a cost. And when I say cost, I mean a literal cost in higher fees. Compared to some of the other ETFs out there, HYLD has a higher management expense ratio, often called the MER ratio, and this can eat into your returns over time. Especially the longer you hold an ETF, the more the MER will eat away at your total return. And specifically for HYLD, they're charging a 2.4% MER ratio. This is equal to some of the highest fees that mutual funds offer. And that's why I specifically stay away from mutual funds, because of that higher fee, which is a no-no in my book. If I had to point out one red flag for me as an investor, it's this MER. If I see a MER of 2.4%, it's something that I typically stay away from. But if you're okay knowing what you're getting in return for a high MER, this may be okay for you, because what you're getting is complexity, but it does come with risk, right? Because it does use leverage. It uses an option strategy, which is going to make HYLD more complex, more riskier, and that's why the MER is so much higher. And that's why it's super important to make sure you have a good understanding of all these investment strategies before you invest your hard-earned dollars and the impact that it's going to have on your portfolio. The bottom line, what you're getting with HYLD is that higher income, monthly cash flow distribution, and exposure to US blue chip companies. Now, what it does is it's going to cost you an extremely high MER of 2.4%, limited upside potential, and you're getting a lot more complexity with increased risk for what you're going to get as a benefit. So if you prefer your investments to be simple, not as risky, less complicated, then HYLD may not be for you. If you're looking for more capital gains, more focus on total return, you're not that much interested in cash flow, the way you want to consider is something like a VUN, which is for the US stock market, something like a VFV for the S&P 500, or a VEQT, which is a global growth equity play. If you prefer simpler, less risky, no leverage, then HYLD will make sense for you. Next up, we're going to look at HDIV, which is the Hamilton Enhanced Multi-Sector Covered Call ETF, and similar to HYLD, it's designed to maximize income from the Canadian market, whereas HYLD was focusing on the US market. And if we look at HDIV, HDIV, it offers an impressive yield of around 12%. With monthly distribution, this can be a reliable source of regular income, and this is particularly appealing for income-focused investors. Next up, we're taking a look at sector diversification. HDIV does hold a mix of sector-focused covered call ETFs. So HDIV doesn't hold stocks directly. It's actually a wrapper. It's a wrapper of other ETFs, and those ETFs hold stocks. And this diversification is important because it helps you manage risk and provides a balanced approach to investing. But keeping in mind, this type of risk management is coming through multiple layers. Stocks that are owned by ETFs, which is owned by another ETF. Just something to keep in mind. And just like HYLD, HDIV, HDIV also uses leverage and borrows up to 25% of its asset value, so it can amplify returns, but also increase losses based on how the stock market plays out. Similar to HYLD, this does use a covered call strategy, so it's selling those call options, generating a premium, and passing on that income, extra income to you as the investor. The one interesting thing that's really piqued my interest about HDIV is quote-unquote outperformance. Since its inception, HDIV has actually outperformed the S&P TSX 60 by a significant margin, and this makes it a standout choice for Canadian ETFs market for those looking to beat the market. But here's what I want to caution you. Past performance doesn't mean it's going to guarantee future results. In its short amount of time that it's been on the market, couple of years, yes, it has beaten the S&P TSX 60, but that doesn't mean it's going to continue beating this index for the long term. I'm very curious to keep following this ETF to see if it can continue to beat the TSX 60 or not. And just like with HYLD, this is a common theme with some of these covered call ETFs, is the higher fees. The MER on HDIV is around 2.67%, even more than HYLD. Again, this is close to some of the highest fees that mutual funds offer. And when something is that high in MER, I tend to stay away from. But this may be a trade-off for you if you are okay with what you're getting, which is that higher yield. And because it uses leverage, it uses a covered call strategy, this is a more complex, more riskier ETF than your traditional broad-based ETFs. Bottom line, HDIV does offer a high yield compared to traditional ETFs, and it offers a monthly distribution. So if you're into that, if you're just focused on income, this could be something for you to consider. However, the MER ratio at 2.67 is just too high for me personally. And that's why I tend to stay away from ETFs with that high of an MER. But if you're looking for total return, maximum capital gains, then options for you to consider would be something like a VCN, which is a broad-based total market focused on Canada, or something like VEQT, which is a global equity ETF. There's something to be said for keeping investing simple, and HDIV offers that increased complexity through covered calls and leverage. If you're not into that additional complexity, you're not into that additional risk, and you're not really focused on monthly income and trying to get as much income as possible, then HDIV or HYLD may not make the most sense for you. It's important to consider all your options before you start investing. Now that I've shown you what HYLD is all about and HDIV, how can you actually take all this information and put it to practical use? Because otherwise, it's just a bunch of jargon. You watch this YouTube video and you spend maybe 12, 15 minutes. I want to show you practically what you can do with this information to see if these investment options, HYLD and HDIV, make sense for your portfolio. Let's take a look at my financial model. So here I have modeled out HYLD and HDIV, how much they're trading for, what their current yield is, how much they're paying on a monthly basis in terms of their dividend. And what I've done is I've done some math to understand that how much would I have to invest to earn $1,000 a month in passive income, $2,000 a month in passive income, and $3,000 a month in passive income. What this shows you is that if my goal is to earn $3,000 a month in passive income, I would have to invest just over $300,000 in HDIV and just under $300,000 for HYLD. And let's say I'm doing some scenario planning. I want to invest 50% in HYLD, 50% in HDIV, and I have $50,000 to start with. As you can see, by doing that combination, I can generate about $537 per month, which is just under $6,500 a year, which is in my annual yield of 13%. By this split, I'm getting about 1,800 shares of HYLD, 1,400 shares in HDIV for 3,751 shares altogether. And that's how I can generate over $500 in my monthly passive income. If I were to change this from $50,000, maybe I don't have $50,000, maybe I have $10,000 to start with. And I keep my same split. I'm generating over $100 in my monthly passive income. So what this does is shows you is that how you can take information that you may see on videos like this, maybe through your own research, how to put some context, some financial modeling. This does not have to be super complicated, but it can show you from a practical standpoint what you can do with this information. So if I have $10,000, now I know how I can generate $100 of monthly passive income by investing in 2 ETFs like this. Hopefully you found this video helpful. Please be sure to stay connected with this channel so I can bring you even more content like this. And don't forget to hit like, subscribe, and thanks button on the bottom of this video so I know that you enjoyed a video like this and you want to see more of it. And don't forget to check out the description underneath the video for useful links and investor tools that I personally use on a daily basis. I've also linked the spreadsheet you saw in this video underneath so you can download a copy and start doing some financial modeling today. If you have a question for me and want to ask me directly, well, now you can look me up on askme.com, ask me your private question, and you'll get a quick response directly from me less than 24 hours from you asking. That's all for now. I'll talk to you in the comments section.